a highest level story in China is that they're facing what is like a very classic macro dilemma, which is that the economy is too weak, um, and would should necessitate easing. And we can go into the particulars about what easing is the right easing and most effective and stuff like that. But the economy's growing too slow, given the baseline productivity growth and employment situation there. And at the same time, they're very worried about depreciating their currency, or allowing a depreciation in the currency as well, even though, the basic underlying fundamentals of the exchange rate dynamic there are, considerably weaker than they have been in some time. And so typically when you see an economy that has a need for domestic stimulation and a need for a weaker currency, you should get interest rates to fall and you should get the currency to fall in order to re-stimulate that economy. And I think China is operating in a way that's basically constraining themselves from being responsive. And when I say constraining themselves, they're making a decision to constrain themselves. They could very well ease monetary conditions or fiscal conditions meaningfully. They have more than enough capacity to do that. Their debt is in their own currency. They could print the money to fund it, to ensure that there isn't an interest rate rise. They have every ability to ease, to support the economy more broadly, and then to respond to the downward dynamics in the property sector. And they also have a ton of resources to be able to manage currency weakness and even totally arrest currency weakness, at least for some time, because they've got $3 trillion of reserves. And so, if they wanted to ease interest rates and do fiscal stimulation and keep currency downward pressure mostly at bay, at least for a period of time before there's weakening elsewhere, they have more than enough firepower to do it. So I frame it all that way because I think it's an important, like, that macroeconomic context is important to then look at and say, what we're seeing in terms of what's going on there is not, it's not an outcome of a set of private sector dynamics that are just happening. It is a set of policy decisions that are being made by the central bank and the central government to, and must be at some level, Xi in particular, to pursue this path of weak economic conditions, and current, and essentially high prioritization of exchange rate stability. And so, I think when you think about the private sector, when you think about the housing sector, obviously there was a lot of housing that was a big part of the sort of, let's call it, fiscal stimulus in sort of a broadly described way, that occurred coming out of the financial crisis and helped support the economy for a while. They're sort of recognizing, I think everyone recognizes that led to a lot of excess spending and unproductive investment, stuff like that. And so it's natural and frankly prudent that they start to pull the plug on all that and try and shift spending and investment towards more productive areas of the market. It's just that they're not doing, so that sort of rebalancing, let's say, it's a bit of a loaded term, but that rebalancing is the sort of thing that makes sense for them to do. And so that part of their policy is a sensible policy. The thing that is, I would say it's not sensible. It's just they are making a choice not to sufficiently offset that with either direct transfer fiscal stimulus or fiscal stimulation that is supportive to investment in other productive areas of the economy. I mean, the GDP per capita is still very low. There's lots of things that can be invested in that would be highly productive. So that policy choice, that's interesting. That's an interesting set of circumstances, it's not, from a Western perspective, they're certainly not solely prioritizing medium-term growth in terms of how they're behaving, how the Xi and the central bank are behaving. And that sort of reaction function, I think, is really important in terms of just thinking about it. If those are their priorities, then basically, if, exchange rate stability is their primary priority and they're okay with having kind of crummy growth, well, if that's their primary decision-making framework, that will not change until the pressure comes off the currency. And the way the pressure is going to come off the currency is by having weakening in the rest of the world. And the rest of the world has been, meaningfully more durable in terms of growth conditions than probably they expected. And so the idea that China will be kind of crummy until the rest of the world weakens, until the PBOC has the room to ease monetary policy, and stimulate the economy without undue pressure on the currency, that's kind of the stasis that we're in.